Wall Street investment bankers are frequently depicted in the media as intelligent or even malevolent geniuses who dominate the financial markets and economy. But at the end of the day, they're just people like us, and they are prone to making very foolish mistakes. In some situations, this costs their companies hundreds of millions, if not billions of dollars. With over $1.7 trillion in assets, Barclays is one of the so-called bulge bracket investment banks and has regularly been rated as one of the most prominent corporations in the financial world. They are in charge of everything from mergers and acquisitions to IPOs and operating a worldwide consumer and corporate banking franchise. The focus of today's video, however, will be one of their structured products segment, namely their iPath exchange-traded notes. Exchange-traded notes are similar to exchange-traded funds in that they may be acquired from practically any stock brokerage. Over the years, Barclays has built a robust ETM organization with billions of dollars in assets under management. The VXX, which follows the price of short-term VIX futures, is one of their most popular ETNs. This product has grown in favor among investors seeking VIX exposure for hedging or pure speculation. Holders of the ETN pay a 0.9% fee to Barclays, which is generally seen to be a fairly safe business. It makes no difference whether the ETN increases or lowers in value. Barclays is paid in either case. You might be surprised to find that they just disclosed a £450 million, almost $600 million loss in its ETN sector. This loss is so significant that they are forced to suspend their previously scheduled share repurchase program in order to move funds to pay it. This unexpected loss was undoubtedly caused by heightened market volatility, maybe as a result of Russia's invasion of Ukraine or the Fed rising interest rates, right? Well, it turns out that it had nothing to do with the market circumstances and was purely the result of gross mismanagement on the part of the bank's personnel. This video will explain what the VXX is and how Barclays lost $600 million. But first, if this is your first visit here at the Smart Stocks Academy channel, please accept my best greetings. And don't forget to hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video is released. So if you're ready, let's get to the video. To understand what is going on, we must first distinguish between an ETF and an ETN. An exchange-traded fund, such as the Invesco QQQ ETF, which follows the Nasdaq 100, is the most frequent variety. When you invest $100 in QQQ, the funds are used to purchase shares of the underlying index. They'll spend $10 on Apple stock, $10 on Microsoft, and so on. Importantly, the ETF is completely collateralized. If QQQ manages assets of around $140 billion, it owns $140 billion in Nasdaq stock. Even if Invesco goes bankrupt, the ETF may be liquidated, and if you own any QQQ shares, you will be properly reimbursed. There is virtually no default risk because it is backed by hard assets. ETN works differently. In this example, the issuer Barclays promises to pay you cash at a later date. The monetary incentive is proportional to how well a certain index performs. Unlike an ETN is only a contract with no assets. Assume you wanted to build an ETN that mimics the S&P 500 index. Instead of buying the 500 member companies altogether, you agree to give the investors a cash payout equivalent to the index's end-of-year level. Because they target the same market exposure, the ETN and ETF are similar as long as everything functions well. Basically, the issuer's assets is the ETF while its obligations is the ETN. VXX is an ETN that tracks the performance of short-term fixed income futures contracts. Barclays is essentially providing VXX investors a cash dividend based on the value of a short-term VIX futures index. During normal times, the ETN will monitor the index value perfectly. As a result of the VXX ETN, Barclays now faces a large liability in the hundreds of millions of dollars. If the index rises, so must the amount paid to the holders. To reduce the risk, they enter the futures market and buy VIX futures worth the same as their liabilities. If the value of the futures increases, So does their obligation from the VXX ETN, but their portfolio of fixed features increases by the same amount. As a result of this, their net position is zero. So in all practical terms, it is completely secure. However, imagine there is another financial crisis similar to 2008, and the bank is driven into insolvency as a result of the risk it took in other parts of its businesses. If Barclays declares bankruptcy, it may be compelled to sell all of its assets and may be unable to satisfy its commitments to VXX holders. This is related to the idea that ETNs are obligations rather than assets. As a result, the SEC requires issuers such as Barclays to announce how many shares of the ETN they intend to issue ahead of time. The problem stems from the requirement to register with the SEC. In recent years, the VXX ETN has grown in popularity. As more people seek to participate, Barclays issues more shares. This means that Barclays must buy back the ETN at the original issue price. With a current market price of $25, the VXX has been underperforming recently. If more shares were issued at the peak, it may go as high as $242. Barclays must now repurchase these shares for $242, a tenfold increase in value. They expect to lose $600 million after taxes as a result of their moves. Because they may deduct this as a tax loss, the actual losses might be closer to $800 million. And the worst part is, all of this could have been prevented. Their product was not faulty. Rather, this was the result of incompetence on the part of the Barclays personnel. They seized the issuing of new shares after discovering the problem as an effort to stop the bleeding. This has resulted in some unusual trading practices. If the ETN ever deviates from its underlying value, Barclays will either issue or buy back shares. Given the uncertainty, speculating on the VXX, whether long or short, would be exceedingly dangerous. The expected $600 million loss led Barclays to postpone their previously announced share repurchase authorization. In the end, this loss is not disastrous to the firm. $600 million is less than 2% of their market capitalization. Nonetheless, their share price performance has trailed behind that of its counterparts. Since the beginning of the year, it has almost lost a fifth of its worth. There's never just one cockroach in the kitchen when you start looking around, Warren Buffett explains. The fact that Barclays made such a blunder reflects a culture of ineptitude and lacks internal controls. Similar gaffes might readily be discovered across the bank's intricate operations. And with that, today's video comes to a close. If you haven't already, show your love and support for this video by hitting the like button, subscribing, and turning on the notifications bell to be the first to know when we have a new video. Thank you for taking the time to watch, and we hope you had a wonderful time. We hope to see you again in our next video.